Diversification is a big mistake. I call it diversification.
In this video, we delve into the strategies of legendary investor Peter Lynch and reveal the stocks he avoided to become one of the best investors in history. By understanding Lynch's approach, you will gain invaluable insights into identifying and avoiding common pitfalls, ultimately allowing you to make smarter investment decisions. If I could avoid a single stock, it would be the hottest Peter Lynch. John heard whispers of a company called Home Shopping Network, riding the wave of the hot teleshopping industry. With excitement in the air and promises of quick riches, John dove in headfirst, buying shares at their peak of $47. However, as Lynch warned, the sizzle quickly turned to fizzle. Home Shopping Network stock plummeted back to $3. John found himself trapped in a whirlwind of losses, wondering where he had gone wrong. The company's balance sheet deteriorated rapidly, burdened by debt and plagued by emerging competitors. Just like the carpet industry boom that eventually fizzled out, or the once dominant Xerox struggling to maintain its grip in a crowded market, the allure of hot stocks often leads to disappointment. Meanwhile, companies like Philip Morris thrive in seemingly negative growth industries by carving out a niche, focusing on brand strength, and adapting to changing markets. Beware the next something. Peter Lynch advises caution when considering stocks touted as the next big thing, likening such expectations to a curse. He argues that companies labeled as the next IBM, McDonald's, or Disney often fail to live up to the hype. Lynch highlights examples like Circuit City's rise compared to its imitators, and the failure of companies branded as the next Toys R Us or Price Club. Avoid diversifications. Peter Lynch warns against a common pitfall in corporate strategy known as diversification. This term refers to the practice of companies making acquisitions in unrelated or unfamiliar industries, often resulting in diminished returns and shareholder value. Instead of focusing on their core competencies or returning value to shareholders through dividends or share buybacks, these companies divert resources into ill-advised acquisitions, which can lead to overpayment, unrealistic expectations, and mismanagement. He suggests that such actions may represent a transfer of wealth from the shareholders of the acquiring company to those of the acquired entity, as the acquiring company often overpays for acquisitions. Despite the lack of clear benefits, some companies persist in this behavior, perhaps driven by a desire for excitement or a misguided belief in the potential of diversification. While Lynch acknowledges that acquisitions can sometimes be strategic, particularly in situations where the core business is struggling, he cautions against the tendency for companies to overpay, overestimate synergies, and mismanage acquired assets. Instead, he advocates for a focus on shareholder value through prudent capital allocation, such as share buybacks, which he views as a more effective use of excess cash. Beware the whisper stock. Peter Lynch, the legendary investor, shares cautionary tales about what he terms whisper stocks, those tantalizing investments that promise astronomical returns but often deliver disappointment. One example Lynch recalls is KMS Industries, a company that underwent a bewildering evolution of business ventures, from amorphous silicon photovoltaics to inertial confinement fusion programs. Despite the grandiose promises, KMS Industries stock plummeted from $40 to $2.50. Another instance is BioResponse, a company claiming to extract monoclonal antibodies from cows for medical purposes. Lynch vividly describes his visit to BioResponse headquarters, where he found executives on one side of the hall and cows on the other. Despite the intriguing premise, BioResponse ultimately failed to deliver, leaving investors like Lynch with only modest gains or small losses. Lynch emphasizes the allure of whisper stocks, their hypnotic effect fueled by captivating narratives and the promise of extraordinary returns. However, he warns that beneath the allure lies a lack of tangible fundamentals and earnings, making these investments highly speculative and risky. Beware the middleman. Peter Lynch warns investors about the dangers of companies overly reliant on a single customer, a situation he terms beware the middleman. Lynch shares the cautionary tale of SCI Systems, a well-managed company that supplies computer parts to IBM. While SCI may appear successful on the surface, its reliance on IBM puts it in a precarious position. One swift decision by IBM to either manufacture its own parts or switch suppliers could spell disaster for SCI. Not only does the supplier face the constant threat of losing business, but they also find themselves at the mercy of their customers' demands. With such leverage, the customer can demand price cuts and other concessions, eroding the supplier's profits and stability. Beware the stock with the exciting name. Peter Lynch warns of the pitfalls of being swayed by flashy names, cautioning investors to beware the stock with the exciting name. Lynch shares the hypothetical scenario of Xerox, suggesting that if it had a mundane name like David's Dry Copies, investors might have approached it with more skepticism. Conversely, he praises companies like Crown, Cork, and Seal for sticking with their original names, avoiding the temptation to adopt trendy or cryptic monikers.